And joining me now is Sean Culverwell from Anchor Capital to share his analysis on the day's market performance. Sean, thanks so much for your time this afternoon. Well, while we wait on those U.S. non-farm payrolls, investors have been digesting company news, inflation data and PMI data out of Europe and assessing the UK's fiscal puzzle. And let's start there. Is that something you're keeping an eye on? Rachel Reeves has a tough task, of course, ahead of that autumn budget.
Yeah, it's a very tricky environment in the UK at the moment. The central bank has a tough task on their hands in that they would like to cut rates to boost the jobs market, but at the same time, they've got inflation picking up. And that for them in a monetary easing environment is difficult to deal with. And on the ground, it's really tough trading in the UK. Consumers are really battling. So hopefully the budget, when it comes out, can give more certainty on the fiscal picture, and they can pick up some momentum in the economy there.
So let's shift gears to some company news. Google managed to dodge penalties and a breakup that would have resulted in the sale of Google Chrome. Somewhat of a win, right? Even though the court ruled that it'll have to share some of its data with its competitors.
Yeah, so the 5-year legal battle finally ends, and so does a potential overhang on the rating. I would say the outcome is a home run for the status quo. I think being found guilty of monopolistic behavior, yet facing such a benign remedy is particularly favorable for the company. It certainly preserves their ability to deepen its partnership with Apple and potentially even integrate its Gemini AI into future iPhones. So as I said, it lifts the key regulatory overhang that has weighed on Alphabet's valuation, and the company had traded at a discount to peers amid fears of a forced breakup. But seeing after pre-market in the US, it's up about 7%.
And this throws that perplexity offer out the window, right?
I would say so for now. Every day the AI scene is changing. But yeah, for now it would make sense if Apple and Alphabet can come together and derive the most value together.
All right, let's move over to some local company news. Woolies taking a knock due to its Australian clothing chain Country Road. Food business still strong though, but not doing enough to offset the losses we are seeing in some of the other business units, with earnings there down over 20%. I'm sure this doesn't come as a surprise. This is an issue. The clothing, the fashion, the beauty side of Woolies has been struggling compared to that food side.
Yeah, so as you said, it's more of the same from Woolworths. They arguably have one of the best food retail operations in the country, and it showed its resilience again in these results with sales up 11%. On the fashion, beauty and home division, it was a weak performance, but pleasingly, it had a much better half. So hopefully exiting this year can maintain that momentum, although margins were difficult. And then, the elephant in the room is the Australian Country Road Group. Sales were down 5%, but the big knock there was a big gross margin collapse. And you saw that gross margin collapse drive the operating profit loss and a big impairment being recorded. So, unfortunately, tough set of numbers from Woolworths. We were cautiously optimistic going into these numbers. But again, tough to see.
I've always asked myself if Woolies has actually considered spinning off Woolies Food and how that would do in the market.
I think it would trade at a decent premium to the general retail basket. Maybe not quite ShopRite's level, but certainly a premium to the rest. And that's been on investors' minds forever. They want that prize jewel in that food business. It's just what happens with the rest of the assets and how much are they actually worth. And I'm sure management have weighed up those decisions in their board meetings, and it's probably an ongoing discussion to happen because undoubtedly that food business is the best business within Woolworths, but it is getting diluted by a very weak Country Road business.
All right, sticking in the retail sector, but moving over to the buildings material side of things, just looking at cash builds numbers. Yes, most metrics are increasing, but we're also witnessing how price sensitive consumers are. I mean, even looking at a competitor like Italtile, where we are seeing those single digit growth when it comes to the bottom line. Just your analysis of that performance and what it speaks to the local consumer. It does seem like discretionary spend is really tight.
Yeah, the local consumer spending has been one of our big frustrations this year. Obviously, a very positive 2024, and we're hoping for some momentum to come into 2025. But it just has not been realized. If you look at the discretionary retail sector, one of the big underperformers year to date, and that's just because consumers haven't been able to open their wallets. In terms of these cash build numbers, I would say very, very resilient. You alluded to the very low pricing environment, but what's positive there is they saw average transactions increase 4%. So managing to get people through the door, which is important. And I'd say in this environment with the consumer under pressure, contractors also, which is a big buyer of theirs, also finding it very tough. I'd say earnings growth of 10% is resilient. And I think one thing that they did really well was have a good look at their store base. So they opened 8 new stores, closed 12 underperforming stores, but then they also refurbished 26 stores. I don't know if you've been in a cash build store lately, but they were looking tired and they needed to put some money in, and it seems that investment is producing the goods.
And it's also interesting to see how even with the refurbishments, they also have that new store look, the smaller stores, that's also saving them some costs when it comes to, leasing and energy costs, because they are smaller stores. And then before we get into the stock pick segment, just your take on Discovery's update, the group forecasting earnings growth of up to 32% and pointing to strength in its local business units.
So yeah, Discovery is our preferred insurance pick in the country, and these results just reiterated why it was broad-based strength. So the Vitality UK and Global Composite business is expected to grow earnings more than 67%. That's mainly due to Vitality Health. So they were coming off a very low base because of a poor claims experience in 2024. But then just shifting to the local business that you were talking about, across the board, it was very strong. So Discovery Insure, very strong. We've had very benign weather events, so low claims for them there. Discovery Invest, benefiting from growth in assets under management. And then the bank, you saw a big reduction in losses in the bank. They've seen good client growth, and they've launched their lending products. So across the board, very, very strong and good momentum.
All right, before we get to your pick, let's take a moment to touch on what counters your industry peers are watching closely.
Company listed in Sydney on the Australian Stock Exchange, but South Africans might also know this name, Computershare. So it's a boring business. They effectively do the financial plumbing of shares and trading, custody, transfer, secretaries, looking after shareholder registers, all those boring things. But you charge a small fee for that and it adds up. And then you are always in possession of a lot of cash, not necessarily your own cash, but there's cash stuck on your balance sheet while it moves from shareholders to a company or vice versa, and you own the interest on that cash. And as we've moved into a higher interest rate environment, companies like this, which supposedly have a liability because it's not their cash, this is a liability that generates profits. And at higher interest rates, it generates very nice profits. So Computershare has seen an increase in profits about 18 months ago as interest rates normalized. And if you expect that interest rates are going to stay at these levels, if not go even higher, then companies with this business model of a float of cash that generates interest income is a very good business model to have. It protects you against inflation. So because of that, I find some value in Computershare shares listed in Australia.
Reinet is going to hold a lot of cash very soon, about 600 Rand per share. It's trading at 520 something. 600 Rand of that will be cash any day now. and then you've got a few private equity assets on top of that as a sweetener. So it's extremely cheap. It's a special situation, call it the asset play. Yuan will do something with the money eventually, but I do think they will buy back some shares, maybe a small dividend. But I won't be surprised if they even go for something like Richmond, just chuck all that cash back into Richmond. It's not expensive at the moment. And then you'll get a re-rating immediately for any share price.
So Raynet and Computer Share, are these counters you see value in?
So Computer Share, not a company I know well, and we don't have any exposure, but it is a very good business with very sticky products. They've also got a liability that generates profits, which is always a positive. So a very strong defensive business model. I would caution that with rates coming down, the interest on cash held will naturally move lower. It has come off about 15% recently and trading at a pretty decent multiple, but for us, the earnings growth outlook is not particularly attractive. And then Raynet is a very interesting one. Given the share price decline of about 14% from its recent peak, and with the adjusted NAV at about 630 Rand a share, it is cheap. But I would say the outlook is very uncertain because the market is prescribing differing probabilities to one of two outcomes. One, the company is wound up through a cash offer to minority shareholders. This assumes that the Rupert family retains all of its investments in Raynet, which will naturally give minorities a greater proportion of the cash. And in this scenario, you could see a cash offer of up to 700 Rand a share. The second scenario is that Raynet remains a going concern with an implicit assumption that the cash will be deployed for further investment. Here you're looking at a lower valuation, primarily due to the greater present value of management and performance fees, and it's probably the lower return scenario for us. But given the company's very conservative style, we don't expect to hear anything material until the Pension Insurance Corp deal has received approval, and that is only expected in early 2026. So for now, the share price just may be range bound till then.
All right. So what are you hanging your hat on today? What's your stock pick?
So I'm going for a different one today. It's Kal Group, which was previously Cobb Agri. And basically, there's two sides to Kal's business. The first is their agri supply business. So here they supply inputs to many Western Cape fruit farmers. Also, farmers are looking to consolidate their vendors, and Kal is one of the only suppliers who can be a one-stop shop for all their needs. So they are picking up good market share. Additionally, the Western Cape harvest season looks like it's going to be a bumper. So Kal should grow strongly off a low base, and tariffs aren't expected to be material. I would say the more exciting side of the business is PEG. So PEG is a fuel service station operator that has the largest share of fuel stations in the country, but its share is still below 5%. So the market is highly fragmented and primed for someone to consolidate. I would also point out that these stations generate retail sales of about 7 Rand per litre of fuel sold and operate at 30% margins, so very cash generative. Kal's also buying these fuel stations on about a 3.5 times multiple, so the acquisitions are immediately accretive to earnings. On our numbers, it's trading on about a 6 times multiple and is expected to deliver strong double-digit earnings growth. So a relatively unknown stock, but one we like.
So Kal Group, one to look out for. Sean, thanks so much for your time and taking us through markets analysis at midday. That was Sean Culverwell from Anchor Capital.